Why wasn't this the first deal?
I imagine that there's been a lot of permutations of this deal over the course of trying to bring the two companies together, and then there might be a bunch of different reasons why you would choose the merger and demerger sort of scheme in the first place.
But I think St. Barbara's hand has definitely weakened over the past 5 odd months.
Righto, g'day money miners. It is all happening. It isn't a cruisy Friday. The term sheet is out for the updated St. Barbara Genesis merger, takeover, however you want to look at it. Bit different now. And we've also got Hudbay Minerals buying Copper Mountain. This is money of mine this Friday. Trav, JD, how are we, lads? Trav, I'm going to slow you down. You're a bit excited about this little term sheet, aren't you?
It's one of the most complicated deals to make sense of. It's become simpler, but when you're trying to just compare how each party is eventuated, it's pretty complicated.
There you go. Well, it's early. We haven't got any announcements out from Genesis or St. Barbara. They're still suspended in trading, but the term sheet has been out on various sources. So, JD, how are you going, mate?
I'm doing well, mate. Excited to be here.
You say that every single day. You genuinely are excited to be here. Right, let's get into the big one. Genesis and St. Barbara, the term sheet is out for the new deal. They've obviously signed a new one. Now, what is it? Genesis are proposing to buy the Leonora assets off St. Barbara. So the Hoover House and Phoenicia Metal things won't be happening anymore. It's no longer a thing. That was in the first deal last year. It's a $600 million deal, this one, for St. Barbara. So it comprises of $370 million in cash, $170 million of Genesis shares given to St. Barbara shareholders, and up to a further $60 million worth of Genesis shares that are contingent on the first ore production from the Tower Hill mine. So for this, Genesis are raising $450 million compared to the $275 they were raising in the last deal. Right, Trav, mate, I know you've been heavy in the computer on this, and we haven't, as said, we haven't got enough information yet. The announcements aren't out from St. Barbara or Genesis. It's purely on the term sheet. Trav, let's get into it. What is going on here?
I think I'll start with the disclaimer that this is pretty early stage. And all we've done is taken a look at a term sheet that's floating around at the moment. And this term sheet is ultimately just going out to fill the placement in order to kind of, and that's one part of the deal is the equity raise. And the rest of the deal is sort of all interconditional anyway. So there's a bunch here, Maddie. My first comment is this seems a lot simpler. In essence, Genesis, they're acquiring a project or projects instead of a company. And the reason that to me is a bit simpler is because the big uncertainty floating about there in the market is a lot to do with what St. Barbara's working capital situation is. And if as an outsider looking in, I tend to think that if you're acquiring a project rather than assuming liabilities of a company when you merge with them, that to me feels a lot cleaner. So, there might be some benefit there. To really get to the crux of whether or not this deal, who it benefits and how much it benefits each party, you really need to do some solid math on what the pro forma companies are each looking like and what sort of each company is going to be getting. And to really be able to do that analysis well, you actually need to have a good understanding of what the current liabilities are of St. Barbara that would have been part of Hoover House. And I think it's that number there that's not out in the market that is really informing the recut of this deal right now. So from what we can see, this deal to me looks like a good deal to existing Genesis shareholders. It looks like a good deal to new coming equity participants. And it looks like it basically looks like, a bad deal for St. Barbara, but it also feels like they had to do it. And
why would you say it's a good deal for Genesis, bad deal for St. Barbara? I know it's hard to sum up, Trav, but can you line it up?
What I'm looking at when I'm trying to figure out if it's a good deal for Genesis is I'm really just looking at what pro forma ownership of the Leonora assets are they going to have by doing this deal. So in the first deal that went to the market back in December, Genesis shareholders, the existing Genesis shareholders, were going to end up with 41% of the Leonora assets, but they were also going to end up with a very small amount of non-Leonora assets because Hoover House would have a 20% shareholding of Phoenician. So existing Genesis shareholders would have ended up with about 8% of the non-Leonora assets if you do a see-through value.
Which I assume there's not much value attributed to those assets in their current state, very poor performers.
It would appear by the way that this deal has been structured, by having a spin out, that there are certain assets that are probably of interest to Genesis management and certain assets that wouldn't be of interest to Genesis management. And that's typically why you would do this, merger and demerger sort of structure in the first place. Before Genesis shareholders were going to get 41% of the Leonora assets. Now on a pro forma basis, they'll end up with 43.5%. That's undiluted for the contingent shares that might ultimately be converted to shares. The real number though that's not included there is actually just what level of liabilities would be assumed by the Genesis shareholders by virtue of the fact that they're now taking on whatever St. Barbara's liabilities are going to be, because it was ultimately MergeCo was there's some pay down of some debt there, but there's also a creditors list that we can't see, which might be substantial, and it's been a while since these companies have reported financials. So
for St. Barbara shareholders, I know they triggered that, was it $150 million debt? That was the point that was the original merger was contingent on that they didn't have debt exceeding $150 million. So
I think it was a bit higher than that, but ultimately the scheme was conditional on this debt threshold, and they haven't breached it yet. But it seems like the deal was recut because it looked like that could be a possibility.
So say they've got $150 million of debt, just to pick that number, they get this $350 million of cash from Genesis. Would that then possibly leave them with a $200 million net cash position, or not as simple as that?
I think it's not as simple as that. The reason I think that is because if you look at the last deal, the last deal was Genesis is raising $275 million, right? And in the use of funds for all of that, at the end of the day, only $70 million of that was allocated to Gwalia and Tower Hill. So when I looked at that deal, and of course some of it was to set up Phoenician and Phoenician's plans and all that sort of stuff, but I kind of, my impression was that the reason you were raising so much money there is it kind of, in some ways was solving a bit of a cash flow problem for St. Barbara that they were experiencing across their portfolio. And some of that was expansion, and some of that might have been working capital. The mix to me was a little bit unclear. And now the deal is not raising $275 million, but it's raising $450 million. And how much of that is going to St. Barbara in cash? It's $370 million. So to me, it now feels like the number, the cash number that actually kind of back solves everything, if there are sort of some cash flow issues, is higher. However, in the process of that, the cash is higher, but St. Barbara are basically getting a much lower pro forma percentage of Leonora by virtue of this recut deal as we see it. The term sheet floating around has the fact that St. Barbara is going to get shares in Genesis, and those shares are going to be to the tune of 15% of Genesis on a pro forma basis. But with the contingent piece, when that sort of converts, they'll end up with a 19.9% shareholding of Genesis. So if you think of Genesis as the pro forma entity with the Leonora assets, St. Barbara shareholders are only going to get 20% of the Leonora assets. Before, in the first deal, they were going to get 38% of the Leonora assets. So that's a massive reduction in the exposure to the Leonora assets on an ongoing basis. And I think that's kind of the price that's been paid for what's sort of eventuated in the intervening time since the first deal, and that was flagged to market by St. Barbara earlier, that we covered earlier.
So that, and it was also in the term sheet that 13% of that, so 13% of the total, 15% of Genesis equity that St. Barbara shares will be distributed to St. Barbara shareholders. So leaving I think it was 13%, leaving 87. Say, is there limitations on the St. Barbara shareholders that get those Genesis shareholders on? Is there limitations on being able to sell those immediately? Is there ever conditions like that?
there are occasions where a company intends to do an in-specie distribution, but they can't because the shares are subject to an escrow, so they have to be held for a while. In this case, that doesn't appear to be applicable. I think this is just a case that the interesting part of that though is that St. Barbara intend to keep 87% of their Genesis shareholding. So St. Barbara is going to look like a pretty funny company at the end of this. They're going to have Atlantic, they'll have
Simberi.
They'll have Simberi, they'll have Catalyst shares, they'll have Kin shares, they'll have a royalty portfolio, but mainly they're going to have Genesis shares, and they want to keep that. So I can see the Genesis shares as a potential funding lever for whatever expansion plans or whatever plans they might have in the future. But the big question mark for me in St. Barbara is how much cash are they actually going to have once they sort of pay down their debt and pay down any liabilities that they might have accrued that we don't know about yet. That's the big unknown, and I think until more announcements are made to the market, that will remain a little bit unknown.
I think it's also worth mentioning that this huge raising can't go ahead without approval from Genesis shareholders. There'll be a couple tranches, and it's going to be a number of weeks or months still before the deal's wrapped up.
Exactly right. So the first tranche is $50 million and the second tranche $400 million. So, and I'm sure that part of that is basically converting RCF and AusSuper's previous cornerstone contributions into that second tranche, I imagine. So the other part though is like if you're a new equity shareholder into this deal, would you have been happier on the first deal that came to market or the second deal that came to market? And I think on my take on that is that I would actually be happier with the second deal that's come to market, mostly because it's just a cleaner support for RAL in my mind. It's a much more distinct break from whatever the St. Barbara's kind of issues might be, and on my math, they're getting roughly about the same deal. If you kind of just work out per $10 million invested, what pro forma percentage of the Leonora assets are they going to get? Well, it works out by my math to be slightly higher, and of course those new shareholders aren't getting any entitlement to the non-Leonora assets. But I think they would be comfortable with that, because if you're investing as a new equity shareholder, the plan here is you just want to back RAL on his plan to consolidate Leonora and make a lot of money and do Saracen 2.0. You're less interested in any kind of kicker that sort of comes from a Phoenician IPO with assets you don't care too much about, and that clearly seem to be a bit of an issue for RAL, and hence why he's tried to chop them out by the demerger before. So I would be happier with this recut of the deal if I was a new equity investor.
And I think just backing great management teams has been a pretty good strategy for a long time, and in particular in the mining space over the past few years, we've seen that. So
he's essentially still becoming the same machine, still becoming a possible 300,000 ounce producer. Nothing's changed there because they're getting what they want. They've taken away the Phoenician Metals interest, that whole thing's, and they don't have St. Barbara in there with them. He's got, I guess, full control now. So it's, as you said, a lot cleaner, a lot simpler. Looking at the assets, they'll still be transporting the Tower Hill dirt all the way to the Mount Morgan's mill. That's a 100-odd K trip. Look, everything still seems to be the same. And
the deal's going ahead because Genesis wanted it to. I think that's why it's been recut.
100%. So it's obviously there's stuff unfolding in terms of just understanding what the liabilities might be or might continue to be at St. Barbara that is worrying. This new deal protects Genesis shareholders from assuming those liabilities.
Why wasn't this the first deal?
I imagine that there's been a lot of permutations of this deal over the course of trying to bring the two companies together, and there might be a bunch of different reasons why you would choose the merger and demerger sort of scheme in the first place.
But I think St. Barbara's hand has definitely weakened over the past 5 odd months.
Absolutely. The other interesting thing in my mind that we should talk about a bit is that, and this should factor into people's analysis of of how things pan out is in the deal that came to market last time, the conditional placement, $275 million was to be raised. $70 million of that was to go towards Leonora. So there was, $50 million for Gwalia future proofing and $20 million for Tower Hill. And in this new deal that's come to market, the $450 million equity raise, in the use of funds, there is no attribution to actually use any of that for Leonora. So the other thing we should keep in mind is that the pro forma Genesis is going to be less capitalized to actually deliver to start developing Leonora province in the way it wants to. And it might have to seek additional funding in order to have the same level of planning for those assets. So if you're doing some like for like basis math, you might actually have to add some further equity dilution to account for that. But the other thing that they avoid though is in the previous deal they were assuming $50 million of St. Barbara's debt, which is no longer happening. And I imagine they would have been assuming liabilities outside of the debt, which they're no longer doing. So all of this stuff matters and we don't have clarity on what the real numbers are. So we can't give a very granular response yet.
If you've got to look at the newspaper headlines in 3 years, whether Genesis are up or down, and you look back to the mere fact that you say, right, Genesis paid $600 million for Gwalia, Tower Hill and the mill, do you think it's going to be that was a good deal or they paid too much?
To start with, I think let's be careful in using the word $600 million because I'm always apprehensive about adopting the headline numbers that are put out to market because anytime there's contingent consideration, you have to factor in the probability that actually gets vested. And in this case, it sounds like Tower Hill is part of the plan, so it ultimately will be vested, I imagine. But I'd rather use the words $540 million plus $60 million of contingent consideration, which might only be valued at $30 million if you were to seek fair value for it. You've got to times it by the probability.
Well, if they don't achieve ore production from Tower Hill, you would say yes, that was a bad deal.
For sure. Oh wow, $600 is a price tag. Again, you'll be able to measure that pretty clearly by the Genesis share price, I imagine.
And I think cost of operation is going to be the big driver in success for this. You're trucking over 100 metres to 100 kilometres to the Dacian mill. You've got high cost of getting the dirt out from underground. I see managing costs going forward as a big thing for Genesis, assuming this all goes through in both tranches, but plenty to look at.
Yeah, and it's a fascinating dynamic for Genesis as well, now having St. Barbara as their major shareholder. Is their ownership in you going to be used as a funding lever?
But if they then have funding issues later on or financial issues later on, is there a risk that they will then dump their shareholding, or will there be the escrow conditions to prevent that from happening?
It'd be a strange move to on-market dump a pretty liquid stock that has good institutional appetite. So anything that would trade there would probably happen via some crossing.
Now, what about Red 5? Last bit of this, Red 5. I know they're Saracen-owned King of the Hill, did a trial underground, sold it, didn't work. Red 5 have had dramas. The Red 5, the King of the Hill mill is 40 k's away from the Tower Hill project, in contrast to the Dacian mill, Mount Morgan's mill, that is over 100 k's away. Pretty sure it's over 100. I looked on the scale. Do you think that's still in play, possible for total consolidation of that Leonora area, or do you think you'll sit at this?
I think their hands will be quite full for the foreseeable.
Who knows? To be honest, like if you had have asked me, would I have predicted that Genesis would acquire Dacian? I would have said no to that. But what happened was Dacian became extremely cheap very quickly, and RAL acted on that. And I think every asset probably has a price, but you never know.
Never know. Right. Thanks, Abe, for all that, lads. Great research, Trav. As I said, great research based on minimal information so far. So we look forward to next week receiving the official announcement. I guess, and everyone's waiting to see, as I said, what the liabilities are, but what RAL's plan is going forward for Genesis. Is he surgically targeting high grade at Gwalia, things like that to make this flow? So JD, Copper Mountain, Hudbay Minerals buying Copper Mountain, a bit more action in the copper scene. You've gone deep into this, mate. What is happening?
That's it. More action in the base metals, the critical minerals sort of space. So I'll give a bit of a high-level view of what's happened here. The deal values Copper Mountain at US $439 million. They're being bought at a 23% premium to the 10-day VWAP. It's an all-scrip deal. Already got board approval. It'll just require shareholder approval on the part of Hudbay as well as Copper Mountain. It'll involve the company Copper Mountain that is delisting their CDIs, a topic we spoke a bit about yesterday. And I think this is sort of in line with their strategy. It'll be an America's focused business. They sold their Eva copper project last year, so it doesn't make too much sense to keep those CDIs listed in Australia. A little snippet that stood out was the joint production for 2023 of the combined entity will be over 150,000 tonnes of copper in the second quartile of copper cost curve. Not every day you see a company flag themselves not in the first quartile, so that was interesting.
Honesty's the best policy, eh?
Oh, that's it. So getting into why have we seen the deal happen today? So last year, Copper Mountain cut their production in half at their operation, also called Copper Mountain in British Columbia. The cash costs of the production more than doubled to $3.53 a pound US, and that was on 24,000 tonnes of production. So no sort of hiding that they just performed pretty poorly there, and Hudbay thinks they can come in, de-bottleneck the operation, potentially add a bit of equipment and just smooth that out. And then we saw that buzzword that we always see that Trav is quite familiar with, synergies. They reckon they can save $30 million every year across all their different assets. So what's the real story here? I think
we should talk about mining synergies. It's a pretty good topic.
Absolutely.
So yeah, I mean, in mining there are genuine synergies when you can benefit from two ore bodies that are sharing the same infrastructure, be it a plant or roads or something along those lines. The typical case though in mining is that it's a lot harder to have synergies when the assets are quite far apart. You can just save on some corporate synergies, which just means you only need one set of CEO, CFO, et cetera. And I think you can save on some administrative fronts there.
Yeah, and I think that's what Hudbay's highlighted here. Their assets are spread across North America, South America, so it's really corporate synergies that'll make up what they're talking about when they highlight synergies in this deal. So we've seen a lot of consolidation in the commodity space over the past few months, really. Newmont, Newcrest, Mincor, Wyloo, BHP, Oz, Liontown and Albemarle, Glencore Tech, the list goes on a while there. China's been doing this in Africa across various commodities for quite a while now, and it seems like Western companies and countries are sort of catching up on that. We also saw exploration jump to $2.8 billion, particularly in the copper space, that is, to an almost 10-year high. It hasn't really been matched by more discoveries, which from the company's point of view is quite disappointing. And bearing in mind just how long it takes to build a mine, I think it'll be in government's interest to promote these things, and it's why we're seeing a lot of these companies make these acquisitions of already producing assets, because they don't want to wait around for a sort of surplus becoming a deficit in the copper space that they see over the coming few years. So what's really driving the consolidation in this sector? Right now, it's a bit opportunistic. We've seen commodity prices be a bit weak over the past few months. That's sort of on the back of global recession fears and whatnot. There's been poor performance in a number of the names we just mentioned that are being acquired. So if you were to compare Mincor, Oz, Newcrest, all those companies with what their share price had been roughly a year or so before the acquisition, then I think the majority of them are down quite substantially. So then we get to the real reason why we're seeing a lot of acquisitions in the space. There's just very few options. You can just do a quick search and look for copper producers and copper companies on the ASX, and you'll get 10 or so hits, and they're not all producing either. So there's really not too much there. And a lot of these
these companies, they have a growth problem ultimately that they have to solve. They've got to persuade that they can't get growth from the drill bit.
Exactly. You look at assets all through the Andes and South America, and the grades are just falling and falling and falling. The mines are getting deeper and deeper. The energy costs, the water costs that all of these things need are increasing. So people are looking pretty far and pretty wide for these sorts of assets. They're going to Mongolia. A lot of companies are going to Africa and to places that are relatively high risk in comparison to Australia.
PNG.
Exactly.
Had to drop it in there. I haven't mentioned PNG for a few days. Sorry, lads. Go
that's
JD.
it. The Congo as well. There's some companies that aren't that afraid to go in there, and that's certainly highlighted by Chinese companies that aren't afraid to go there and do business there. So
you look at how many drill meters, exploration meters, Sandfire put in and around that DeGrussa project to try. They found the 1 million tonne Monty deposit, but the amount of drilling they put in and elsewhere in exploration for 10 years, and their share price is only, it's had a bit of a tick lately, but they've just essentially done nothing for a decade.
Yeah, talk about looking far and wide. They paid $2.5 billion, I think, for Matsa, which is ramping up to nameplate capacity. They've got Matheo coming online in Botswana. Interestingly, the neighbouring asset there, which is held by a private equity group, looks like it's coming up for sale. So we'll see if they'll be getting their hands dirty acquiring that again.
That's Comical.
Exactly, yep. And also, of course, the new CEO starting there, but really looking into which companies could be next, who else could be acquired, it's quite an interesting sort of discussion when we talk about the majors wanting to secure production and secure reserves and resources. Companies like 29Metals, their stock price has halved on the issues that we sort of flagged, speaking about Ernest Henry at Capricorn Copper for 29Metals. But a lot of the names are quite complicated. You look at AIC and they've got between FMR and between the directors there, 40% of the stock held, so that wouldn't be an easy acquisition. Aeris Solpats owns about 30% of the company. Carnaby have got a maiden resource coming out this quarter, so it'll be interesting to see how that sort of plays out. Caravel have a project that will require a huge amount of money if that can be developed into a mine. North Park's up for sale, rumoured in New South Wales, so there's a lot of action, and I think it's a space we've seen a lot of institutional investors move into and looking to move into.
Yeah, the ASX space is very few producers. There is a handful of developers that have had a resource for a long time that's never been developed because it's a big capex number, and I think that funding equation, the tides are turning, and some of those projects look more financeable now than they have in a long time. But they're going to need capable teams to come in and help build these projects. Rex Minerals is another one that comes to mind on that front too.
Do you see copper to be a bit different to commodities like, say, lithium? So look at Albemarle, we're proposing to take over Liontown because they're wanting to secure lithium supply for their downstream facilities. But let's say look at a copper producer like Sandfire. Is it a bit different in the copper world? Do you think that they're not seen as a takeover target for someone to secure copper supply?
I think the majors would definitely be interested in securing supply, whether that's in nickel, copper, lithium. I don't think the commodity really matters with regard to whether these companies want to secure supply.
Would they want to secure it, hoping, like anticipating there's going to be that uplift in copper price?
Well, I think like if the copper and lithium are not a direct comp in terms of the supply, the way the market. I mean, like copper is subject to a very sort of active trading market. Lithium not so much, and so like when a company is getting finance for a copper mine, it's the traders like the Trafiguras of the world, etc., can come in and make that financeable. That same sort of market participant doesn't exist in the lithium market. So I think like you haven't seen the same level of downstream interest in copper security purely because you have a much more liquid market that's facilitated by these other market participants and a liquid LME ticker.
I think in the sense of majors wanting to have a portfolio of assets, and of course, why are they doing that? Because they think these assets and these commodities will appreciate in prices. That's the core reason why they're doing it, though. So completely agree with what you're saying there, though, Trav. But they're in the business of making money, and if they think copper's going to go up in a few years' time, that's why they're securing these assets. Beautiful.
Oh, it was supposed to be a casual Friday, lads, but she was a pretty busy one. Oh, one thing I wanted to clear up from the panoramic analysis the other day, because their announcement quoted 30% lower jumbo development meters. It was a bit convoluted. It was actually because they dropped the jumbo off in the previous quarter announcement, so it's seen as a positive for a reduction in cost. But the way it was worded, it looked like it was negatively worded. So just to clear that up, I had a mistake there. We'll get into the recap of the other news out there. There is other news. Bellevue, they've been added to the ASX 200, now capped at 1.7 billion. So you can expect added liquidity there. Boys, explain why there will be added liquidity.
It's quite a simple one, Matty. These companies like Vanguard, BlackRock that make the indexes will need to go on market and buy shares in the company to put in their ETFs that passive investors buy around the world.
There you go, sorted. IGO, so they've secured some land in Kwinana, right adjacent to the Tianqi lithium plant there. So that's from the West Australian government, and it's for the proposed integrated battery material facility generating the downstream materials for battery cathodes. So they're working with Wyloo towards making a final investment decision on the development of this project, and they're going to it's also going to involve integrating a downstream nickel refinery with a plant that's going to be producing, as we mentioned, the nickel-dominant precursor cathode active material, PCAM, you'll see, for the battery supply chain. Nickel Industries, NIC, they've issued $400 million of senior unsecured notes at 11.25%, 5.5-year maturity. Tropical Cyclone Isla is set to cross the Pilbara coming up. So ships have been moved from the port, so more rain coming to the west now instead of the east. And Polar X, they're up 30% today on high volumes with no news. So Polar X are the company that Northern Star took a 10% interest in last year. So they've got the high-grade epithermal gold exploration project in Nevada. So keep a look out there. Thank you very much, lads. Have a good weekend.
Have a good weekend, Money Miners.
What is up for the weekend, boys? Behaving yourselves, are you?
Oh, I got some plans, Matty.
Oh, that's good. Not disclosing.
We're coming over yours for a barbecue.
Oh, yeah, you are coming to mine. I said I didn't know if you didn't want to disclose your location because you didn't want the fans to bug you in the street.
Mate, I was actually just thinking in my head, what am I doing this weekend?
We'll rest up so we can bring good quality content to the viewers next week.
That's right. Yeah, that's exactly what we're doing.
You've got to cater.
A 5-day week next week.
We're definitely not getting on a piss up at my joint on Sunday. So, too easy. Have a good weekend, Money Miners.
Thanks, guys.
All right.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.